Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. In this weekend show, we're going to be focusing again on commodities, a lot on precious metals, as boy, oh boy, we are seeing some very nice moves and acceleration to the upside, some key breakouts, and also seeing a number of the underlying equities, many of which were struggling over the last 4 years, start to show some life, with the big question being just how much longer can these rallies go and how much more upside could the equities have. We're kicking off this weekend show with Mike Larson, editor-in-chief at MoneyShow. Now, Mike, you're very much a generalist, commentator and investor. But as I said, I want to stick to the commodity sector here because those are the most exciting moves that we're seeing as we ended Q1 and moved into Q2, starting with precious metals. As we're recording this later in the day on Wednesday, gold is over $2,300. Silver is over $27. Can you break down exactly what we're seeing move-wise in terms of precious metals and how much longer you think this run could last for?
Yeah, absolutely. I mean, look, we've been talking for months on end. It seems that all the conditions are kind of in place for things like precious metals to really get going to the upside. I mean, we've talked in past episodes about the dollar going from sort of soaring to slumping to stabilizing, and that takes that governor off of a lot of commodities, precious metals included. We've talked about how, there's been a lot of foreign buying, particularly out of Asia in the gold precious metals market. We've seen, the fact that these types of assets in sectors, when it comes to miners, for example, have been kind of left for dead and are very small, relative to these other extremely popular sectors that everybody owns, tech and so on. And we've talked about how people are kind of be looking for new leaders in a market where we go from worrying about recession to saying, hey, this economy is, not just in the U.S., but in overseas markets, may start to reaccelerate a little bit. So what you've seen is all of those factors that were kind of percolating in the background really start to come to the forefront of investors' minds. And that's what I think you're seeing here. I mean, we already saw it with gold breaking out several weeks ago. We're starting to see silver follow through. As you mentioned, copper is starting to move here. Oil, in the U.S. has topped $85 a barrel. In global markets, when it comes to Brent crude, it's sort of hitting away at that $90 level. So it's a lot of ingredients that, again, or I should say, it's a lot of things where the ingredients were there. It just kind of took a catalyst for everybody to have that aha moment and say, geez, I don't want to, tech was the big thing. Mag 7 was the big thing. I've made a ton of money in the old big thing, and now where can I find the next big thing? I think that's kind of like the thinking that's going on Wall Street. And the rotation you're seeing into big money, looking for the next big winners. If you listen to what you heard on this show, and kudos to you guys for that. Some of what your guests have been saying, what we've been trying to lay out a case for. Patience is being rewarded. Godot finally arrived in this version of the book, so I'm pretty happy.
Yeah, Mike, it is nice that we've been waiting on Godot, and he finally showed up to the party here. As you pointed out, with not just gold and silver breaking out, but copper breaking higher and oil breaking higher. Look at the copper stocks, the producers. Look at the oil producers breaking out. You've mentioned off, Mike, that this is all kind of turning into a reflationary trade, maybe on optimism that the economy is not falling apart, as so many thought was going to happen. Could you break down a little bit more about the reflationary trade and some of the macro forces you think are at work here?
Yeah, sure. I mean, you've had this environment, again, where everybody's kind of, what's the Fed going to do? Will they, won't they? When are the cuts coming? And so on and so forth. But what you've started to quietly see is some of the foreign economic data, ironically enough, out of China, which seems to have been left for dead for ages, has been picking up a little bit. You've seen in the U.S. clearly the mentality be that, hey, the U.S. is going to dodge a recession. It's having a soft landing, or even many people are kind of coming around to that. Do you even call it a soft landing? Maybe it's no landing at all. Things like the jobs data we've gotten has kind of underscored that. So, if the Fed can get money to a reasonable level, get risk-free rates up to a reasonable level that, is normal by historical standards, but not extremely tight, and then you've got kind of, some of these growth drivers in the U.S. economy kicking in, as well as just foreign economies like in China not getting worse and maybe improving a little bit, that's all you need. And what's really interesting, I mean, we're only a few days into the second quarter, so you don't want to make too much of it. But in addition to gold and silver, or excuse me, in addition to gold continuing to run, silver starting to follow, copper turning up, oil performing very well. You've got the yield curve that's been steepening a little bit. And when you look at equities, you look at the sectors that are performing, tech has it's not crashing or falling apart or anything, but it's basically stopped going up and it's been consolidating. Meanwhile, you've seen things like financials, like energy, like industrials, like materials all pick up, especially in the last 30 days. I mean, you look at the performance, just to throw a few numbers at you, the XLK is the tech ETF. It's down about a percentage point in the last 30 days, but the materials ETF, XLB, is up 6%. Financials are up 4%. Energy's up more than 12%. Industrials 3.5%. What does that tell you? Those are all the kinds of sectors that do well in the early stages of an economic acceleration or reacceleration and growth phase. So I think it all sort of throw it all into a pot, and it's telling you the market's more optimistic about growth, economic growth, I should say, cyclicals and things like that. So money is rotating out of this, the formerly market darling tech Mag 7 type names and looking for the next phase's winners. It's broadening out. And frankly, from a big picture standpoint, that's bullish. You can't just have 7 stocks, leading the market forever. You need to see, the broader economy start to benefit, other sectors start to benefit, and that's exactly what we're seeing here. So, all systems go as far as I'm concerned.
Yeah, it's something you've been pointing out for the last over a year now was more sectors starting to partake, or just a general more bullish outlook for the markets after 2022 that was a tough year. But balance this out for the gold argument here, where inflation, yes, gold is usually an inflation hedge, although that has been mixed in history. But gold versus economic growth, I thought if the economy was growing at a fast pace, that people would leave gold behind simply because they would have other opportunities. Or is it, as you said, this rotation trade because, well, some of these gold stocks have really lagged a lot of other sectors?
It's partial rotation. It's, money going into things that haven't yet moved from things that have moved a lot. Part of it is that the dollar, despite the fact the U.S. economy, looks decent, if you have foreign growth too, you're not going to see money pouring into the dollar because there's no good options elsewhere. You're going to see some of it stay in foreign domiciles. So that's why the dollar, after that big run up in 2022 and then the retracing, I don't know what it was, 30-40% of that move or so in 23, it's basically been sideways since. That's okay. That means that you don't have that governor in the face of gold. And if you've got other things like a Fed that is not going to be hiking rates, maybe they're not going to cut all the way back, 5, 6, 7, 25 basis point cuts. But maybe if they just say, hey, we've reached a pretty comfortable level, maybe we'll throw 1 or 2 cuts your way and then sit on it. Whatever the scenario is, it's not never-ending tightening, never-ending hiking, and that driving a never-ending dollar rally. So it's really just the removal of that governor. I mean, when you've got all those factors that have been sitting there, and you just, it's like you take that away, you take the, whatever metaphor you kind of want to use, that's what you're seeing now. So, if the economy were really going gangbusters to the upside, to the fact that the Fed had to say, oh no, now I've got to start hiking again aggressively, that's not going to be good for gold, but we don't have that.
Well, Mike, I'm just curious because you are more of a generalist investor. You look at a lot of different sectors, and at the MoneyShow events, which you're getting ready for another one just here in a week or so, there's mostly generalist investors that attend. With AI breaking out, all we saw was endless news releases about it and magazine articles about it. When cryptos break out, we hear about it all the time. Are you starting to hear through the grapevine with generalists that some of them are looking at the commodity sector again, not just gold, not just silver, but also copper, also oil? Are people getting more interested in the raw material space from your vantage point?
I would say starting to get interested, but nowhere near where it's concerning. I mean, the most powerful moves in any bull market, whether you're talking about gold, stocks, you name it, is when you start to have the, not just the early adopters that are kind of putting money in a segment, but you're starting to get more mainstream recognition. And then obviously once everybody's on board, that's when you kind of, the early people want to get back out, and that's when you have to worry about too much enthusiasm. I'd say we're turning that corner a little bit. We're getting some more interest in it. We have a couple more speakers that have been right about it that, we're certainly looking at getting involved with events and talking about it. But you look at ETF flows into things like the metals ETFs. They've been lackluster even as money's been flying into crypto ETFs and things like that. When you look at sort of mainstream coverage, it's starting to talk about it. I mean, I have seen gold start to show up in the Wall Street Journal and so on, but is it a case where everybody's like, holy cow, I want to get all my money into this? No, you're not. So I think that's another, even from a sentiment standpoint, that's another reason why I'm so excited about where we are in this phase, because you're starting to convert people. You're starting to hear more people get interested. You're starting to see people say, hey, okay, I've been holding this for a long time. It hasn't done much. It's starting to make me some money. But it's nowhere near that sort of manic phase like what you saw a couple years ago when all those SPAC and other, garbage tech stocks, what you've seen when you've had, crypto boom a few years back, and that, sort of brought in all these fraudsters. So I think this is, again, even from a sentiment standpoint, this is a great point in that cycle, that phase where you can really start to see, coming out of that long consolidation, some pretty healthy acceleration, driven by money flow and all the other things we've talked about.
Since you brought up cryptos there, then, Mike, how do you balance out this renewed bullishness in commodities broadly, the trade into commodities, and crypto that has also been bullish?
I kind of try and look at, I think some of the same underlying factors have been driving crypto and will be driving crypto and gold. And when I say crypto, I mean, I think speaking about Bitcoin and some of the larger types of cryptos in there and that are more asset class oriented as opposed to the super speculative junk. I think some of the same trends are driving it, but I always look at it as the tortoise and the hare, right? I think that they both win the sort of performance race. It's just that, Bitcoin and crypto is kind of like the hare, and gold is more like the tortoise. It's a slower moving market, but it's tending to benefit from the same underlying trends. So it just sort of depends on your risk tolerance and how much excitement and drawdowns and things like that you can handle. I mean, you'll probably make a lot more money in a bull market in something like Bitcoin or some of the riskier cryptos, but you're also going to have much more roller coaster type activity than you're going to have in something like gold. And I think both are kind of now in bull market territory and likely to remain that way for some time.
Well, Mike, it sure is nice to have a discussion in bull market territory for the commodities, for the precious metals, for cryptos, really for almost all markets. Is there anything that could throw a wet blanket on this, just looking at the other side of the coin, looking at the bearish thesis, anything that you see on the macro front that could interrupt this pattern?
Yeah, sure. I mean, look, if I'm ultimately wrong and some of the people that I trust a lot, whose work I follow, are ultimately wrong about the Fed, and the Fed really has to, get back into hiking mode, this turns out to be, oh, geez, we didn't hike enough. Now we're going to have to play catch up to a new broad inflationary phase, or, we're going to have something like that leads to a renewed surge in the dollar. That that is really, I think, the biggest spanner out there that can be thrown in the works. But, I've been following the Fed for a quarter century. A lot of the smart people that I follow, who do speak at MoneyShow events, whose work I digest in the newsletters and things like that, really kind of have really been right about this market. It's not just that they have great track records long term, it's that they've really had their finger on the pulse of this environment for the last couple of years, are sort of on the same page. So I like to be in good company. And I think that in that environment, that's really the only risk, but it's, in my opinion, not a likely risk. I think this is firmly, and even let's back up and even from a technical standpoint, you're talking about a market, whether you're talking about gold or silver, that's consolidated for a couple of years now in a broad trading range in the face of a lot of bad news like a surging dollar and so on. And yet it held there. And you have a market where the mining stocks are just now starting to convert to sort of confirm that, as opposed to running forever and then starting to top out. I mean, from a technical standpoint, all that sort of speaks to this being an early phase of a pretty powerful bull move. So I don't want to sound Pollyanna-ish, but I think there's sometimes when you really have to say, hey, look, there's technicals, fundamentals, currencies, cross-market, sentiment, all of these factors that have come together. And to me, that's a pretty powerful bull market signal.
Yeah, you're right. Sometimes a lot of the time, I think you do just need to ignore all the noise and look at the charts and see what they're telling you. And right now, boy, oh boy, it's all starting to move higher. You did mention some of the international considerations that you had, even with China starting to pick up a little bit. And as much as we look at just what the Fed is doing, what's important for investors to look at globally here when it comes to either central banks, economic data, or any other sort of market moves?
Yeah, well, we have to be cognizant of geopolitics. And I hate to use such a sort of blasé term to talk about some real scary things and unfortunate things that are happening in the world, whether it's in, still in Russia and Ukraine, or whether it's sort of saber rattling between China and Taiwan and other parts of Southeast Asia or the Middle East, of course. Those are all issues that you do have to keep your eye on. You do have to understand that curveballs can be thrown at you from almost any time from those types of things that are unforeseeable, or at least how do you prepare for it? You kind of keep some safety there. And ironically enough, is that not also tending to be a supportive, if not, outright bullish for things like precious metals? I mean, they tend to do well in periods of instability, and obviously some instability is what we're dealing with. So, even there, again, even from the geopolitical sort of background worry thing, that tends to be supportive for precious metals as a hedge. So, that's more what's happening with that is more of a concern for things like broader stock market exposure and whether or not the stock market can hold its gains, in my opinion. And I think, one thing about the markets, broadly speaking, as this rotation happens, I wouldn't be surprised if the overall market tends to stagnate a little bit and just catch its breath. I mean, the S&P had its best first quarter since 2019. You've had a good run, and I think just some of the early jitters we're seeing in the second quarter, early on, is just part of that sort of rotation, period and consolidation. So, I wouldn't be surprised if the broad averages take a breather here, but within them, I mean, again, if you're in the right stocks, you're in the right sectors, you're in kind of the next big thing, or things for that matter, I think you're going to be pretty happy as an investor, and that's what we're seeing.
All right, Mike, we'll wrap it up here. Thank you very much for your insights. Man, oh man, it's been a week full of a bullish outlook for commodities, and that's from some of our generalist guests as well, rightfully so. Look at the price moves and look at the follow-through that we are seeing finally in some of the underlying stocks, even the smaller ones. And Mike, thank you very much for taking time on this weekend show. Everyone stick around. We're going to be right back continuing to discuss some of these moves in the commodities sector.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we are going to continue to focus on commodities and the strength we have seen in a wide range of commodities, mostly in the oil, copper, and gold sectors. But in these last two segments, I also wanted to factor in currencies to this because we are chatting with Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Marc to Market website. Now, Marc, it's an interesting environment here where the U.S. dollar this year, so far in just over a quarter, has been quite strong. The dollar entered the year right around, let's just say 102 on the dollar index, currently up to about 104 and has been kind of steadily rising, but we're also seeing commodities rise. Copper being one, gold being another, oil also coming up. Maybe this all means that the economy is just that strong that people are encouraged to put money to play in commodities, but usually currencies, that if the dollar's dropping, that can help commodities. So how are you balancing out this environment here, Marc, where it's currencies and commodities moving higher?
Yeah, it's quite remarkable, huh? I mean, just thinking about how strong the dollar has been and how strong several of these commodities, like you mentioned, have been with new record highs in gold, for example. We've seen some of the other softs rally. But I think that, yeah, it's always like the refuge, right? If you can't have a general explanation, then we have to drill down, and that's what I suspect's happening. The commodities like copper, gold, and oil have their own idiosyncratic drivers. And we can talk about those. And I think the dollar is in a somewhat different driver, but what they have in common, I think, is that the U.S. economy, I think that the evidence is beginning to accumulate that rather than all this recession talk we've heard, that the U.S. economy looks like it's reaccelerating. And that speaks to demand. But that's not why I think that oil is up. It's not really on U.S. demand. I think that we've seen in oil, for example, Mexico this week announced that it was going to cut back on its oil sales, which are, I want to say, about 600,000 barrels a day. And it's sour crude that the U.S. refiners, of course, are built for. And they're cutting back on their export sales because they want to boost domestic gasoline sales, ostensibly ahead of the June elections. Copper is a different story. And there, of course, it's not the dollar that's the driver there. But I think, again, it comes to a lot of these industrial metals. We really have to look at China. And it looks like Chinese copper plants are working towards a cutback in production. And I think that's like part of the story of trying to rationalize Chinese production. And when it comes to gold, I think the gold story, of course, everybody talks about the central banks buying, but I think that we've seen a lot of Chinese retail buying, Indian buying. And I think that countries in which they have questionable central banks, capital controls, and sort of concerns about their currency. China's been on holiday for the last 2 days, and so Monday's fixing by the PBOC is going to be important. But I think that, if you're in China, it's not clear about stocks. Some of the big names like Alibaba are still selling off. You have these capital controls, and you got the currency weakening. And so what can you do with your money? You can't invest really in property, questionable about stocks. And so gold gives you an alternative within the capital control system that they have to diversify and to have a place to basically preserve capital.
Yeah, Mark, I think you're right. I think that obviously central banks have been buying gold, but there has been a lot of things on social media talking about the youth in China buying gold beans and that people are buying gold in India, and that actually with gold prices moving so high, a lot of people in India have shifted to buying silver. We've also seen silver break out of its trading range this week, pop above its resistance at 26, 26.50. Now it's up in the mid 27s. So I think some of that gold buying in the East is also spilling over into silver. But when you look at copper and oil going higher, those affect the economy. When you look at Dr. Copper, it's the strength of manufacturing, electricity, the wiring, that goes into the whole global economy, and it's moving up, the good doctor. And then oil is a input on almost everything. So how do you think those play into the inflation picture? Because we're going to be getting inflation readings next week, but the longer term inflation picture, how will these higher commodities factor into that?
Yeah, I think that's a good question because, we're all familiar with higher oil prices, higher gasoline prices, and efforts to sort of run counter to efforts to dampen inflation. Traditionally, the Federal Reserve sees higher oil prices, though, as deflationary in the sense that, yes, energy prices go up, but the more energy prices go up, the less money the household has to have discretionary spending because they have to spend more of it on energy. Or that's sort of the general idea that inflation is about the general price level. When we talk about higher oil prices or even higher copper prices, we're really talking about specific price levels rather than the general price level. So I do think it's going to be worrisome, and I think we've had a very strong U.S. jobs report, and next week we should be looking at a CPI in which the headline might even go up a little bit, and the core rate slip tiny. But if the Federal Reserve is looking for greater confidence that U.S. inflation is headed towards its 2% target, the confidence probably is not going to be raised, that it's not going to be improved by the strength of the jobs data and the firmness of the CPI next week. Higher oil prices, higher commodity prices, especially if those higher oil prices are linked to potential supply disruptions as the war in the Middle East looks like it might be expanding. And so I think that all that just makes it more difficult on maintaining this price stability type of goal and progress to boost the Fed's confidence. But I think the market, we've had a lot of Fed comments this week, and I think on balance, the market is saying there's still a little bit better than a 50% chance of a Fed cut in June. And if they don't cut in June, the market's got it nearly priced in for July. I don't see that being shaken yet after today's U.S. jobs report.
Now, Mark, these rate cut expectations have actually come down a fair bit from where the market or what the market was expecting last year and then even into this year, but it hasn't seemed to impact the markets or really any market significantly outside of the bond market, which has sold off and rates are higher. Does it really matter? Should we be paying attention to what these rate cut odds are, or does it matter more what the economic data is, or simply what the charts are telling us, where it seems like strength in a number of markets is still here?
Yeah, so I think it matters like where you sit. I think that there's no, I mean, I think one has to, in trading, one has to respect the price action. And I think what that means ultimately is that what really, it seems to me, just my experience would be something like this, that people who make money in the market don't make money because they're right more often. They make money because they're more prudent, disciplined risk managers. Everybody knows what to do with the winner. It's what do you do with the losers? And so I think that's the problem right now, but I think that we get these conflicting signals. So I think it is important to recognize that, yes, the U.S. economy still looks fairly resilient. The talk about recession seems to be misplaced. But typically, the U.S. economy doesn't have a recession in the fourth year of a presidential term. As an election year, we typically don't have a recession. Typically, stocks go up. And so what this means, though, that historical sort of record or that pattern is more likely the recession comes in the first year of the next president's term. I want to say that out of 11 Republican presidents, we've had a recession the first year of 10 of them. And so I think what this means then is if you're trying to manage a business or trying to like think about mortgages, that the risk is that we don't get the rate cuts until later this year rather than, say, June or July. But that rate cuts will be coming, and the idea that, yes, that the trend, and this is, I think, Powell's point, is the trend on inflation is lower, even though he calls it a bumpy path. And so I think we got to like look through that, the bumpiness, and focus on the big signals. And it's hard to imagine how the U.S. economy can maintain, say, robust growth when Europe is stagnant, Canada looks stagnant, China has its own difficulties, and can the U.S. be prosperous when the rest of the world isn't? And I'm not so sure that's the case.
Well, Mark, one of the takeaways I have that seems bumpy indeed is, and to Corey's point in the intro here, is that it seems like what we've seen the last couple of years, the correlations have all broken down, because for years and years, really almost decades, gold going up with real interest rates, real inflation-adjusted interest rates, positive as they are, wouldn't be something you'd expect to have happen. With rates and the dollar going higher, you wouldn't expect to see the commodities going higher at all. You wouldn't expect to see the markets doing as well as they are with rates and the dollar going higher. So it seems like a lot of the correlations that we've been seeing in prior years have all broken down over the last 12 to 18 months. What do you make of just the mix up in all those correlations breaking down? And it seems like, to Corey's point, everything's up. Doesn't matter if it's the rate, the dollar, the market, cryptos, commodities. It doesn't seem like the traditional correlations are holding anymore.
Yeah, welcome to my world. People like me, we use these correlations not as I guess it's sort of like the lamppost, right? A drunk might use a lamppost for support. Other people could use that lamppost for illumination. And people like me, I think, have used these correlations more for illumination, but as they break down, it becomes more difficult. And it reminds me, when I was earlier in my career, I was at Dean Witter, and Dean Witter was owned by Sears. And as a currency strategist, oil prices were taking off. And as a currency strategist, I was recommending being long sterling, oil exporter, short the yen, oil importer, as a way to play the oil market, the oil rally, through the currency markets. And I remember my boss called me into his office and he said to me, he liked the idea, but he said, if you have a view on oil, trade oil. If you have a view on sterling, trade sterling. Don't confuse the two. And I think that's really a good reminder that when it comes to correlations, that they're not perfect. And even if you have a week or two, when we talk about a correlation, say a 100-day rolling correlation, and for 1 or 2 weeks, those correlations look weaker, that relationship seems to break down, it might not really affect the correlation all that much. Right? If you have an 80% correlation, which seems very high in the financial markets, it still means that 1 day a week, it's not going to work. And so I think we just have to keep in mind, and again, it comes back down to risk management, but I do find that these breakdown of the correlations that you mentioned are sort of make it so it's almost like in a boat without a rudder. And I think it just makes it more difficult. And I think maybe that's why the market, even though we have relatively low volatility through most of the capital markets, why trading has become so difficult.
So, Marc, when we're looking abroad, you even brought up China there for a little bit. We have seen maybe slightly better data out of China, and China can be such a driver behind commodities broadly. And I think, quite frankly, China, if they're strong, can play into the strength of a lot of other countries as well. What are some of your considerations when we look outside of the U.S. borders to China and how important they are in the global picture?
Yeah, it's funny that today and yesterday, I believe U.S. Treasury Secretary Yellen is in China, and she's, I think, lecturing them about their overcapacity in many industries. And the key ones these days are the EV, the batteries, solar panels, steel. And I think that the huge China is just so big, and what it does, just by its sheer size, impacts these world capital markets. I think that the risk is that China is, even though we kind of consider China as some kind of like communist or socialist country, I see it more as a state capitalist country, where the state acts as a capitalist. You have wage earners, you have profits, you have all the markings of a capitalist society, except you don't have as much of a role for the free market or the private sector. So China's got this overcapacity, and I think that the big problem down the road is how do we in the West, U.S., Europe, Japan, how do we make room at the economic table for China while China is being its modernization is so disruptive. So when I think about the world economy, of course, China is very important. I think many of the critics of China say it needs to boost consumption. When I look at the numbers, I see China's consumption per capita has doubled in the last decade. Imagine that. Imagine if our consumption in the United States, Canada, or Europe were to double in a decade. It's just huge. The problem, though, is China still has huge investments as they try to take the what Lenin called the commanding heights, trying to dominate what it imagines to be the growing sectors of the new economy. And so this poses a challenge, and I think that this is sort of where we are. I think that China is adamant about doing this, and the U.S. trying to slow it down, denying it, say, semiconductors, advanced semiconductors, and encouraging companies not to service the older sort of legacy technology either in China. I think it's a precarious situation. I'm afraid that if we don't do it peacefully, there'll be conflict. And I already see next week, the Japanese Prime Minister Kishida and the Philippines President Marcos are coming to the United States. And I imagine that out of that meeting with Biden, there'll be an announcement about some new defense initiative, whether it's a new security agreement between between Japan, Philippines, and the U.S., or whether it's Japan joining the Australian, UK, U.S. submarine deal. But I think that we're gearing up for a threat of greater confrontation. I know a lot of realists who are listening to your show. They think that the way to avoid war, the way to ensure peace, is to prepare for war. And I think that's sort of the movement that I see happening.
Well, Marc, you brought up Japan there. I'd like to get your thoughts on the economic side of Japan, which used to be number 2. Now it's number 3 as far as world economies. They've done so much to change this year compared to the last 2 decades as far as their monetary policy. How is that playing into the yen? How is that playing into the Japanese economy? And also, let's weave in the European economy and the euro currencies.
Yeah, sure. Out of the major industrialized countries, Japan seems to be the one changing the most, not only on the interest rate side, but Japan is opening up for the first time to immigration, and they too have a shortage of workers, part of the aging population and shrinking population. The key right now is that the dollar has risen to about 152 against the yen. That's where it peaked in 2022 with the help of Japanese intervention. It peaked there as well in late 2023 without the intervention, but with a lot of threats of intervention. we're bumping up along that now, and the threat of Japanese intervention is sort of making the market a bit more cautious. But think about what's happened this past week. The U.S. 10-year yield has gone up 20 basis points, maybe a little bit more, and yet the dollar yen hasn't gone up, partly because the threat of intervention. And so I think that I think it's sort of like a dam, and maybe we get that a firm CPI next week, higher U.S. yields. The dollar goes through that 152 level. It's like a dam bursting. Many people are talking about maybe a quick move towards 155. But the Japanese economy does seem like it contracted in Q3 last year, recovered a little bit in Q4. This quarter looks a bit shaky because of an earthquake they had on January 1st. But we saw this week is stronger than expected household spending, and this is before the wage increase kick in. Next month, May, the subsidies for household energy usage is going to be end. But in June, the Japanese are going to get income tax cuts. And so people expect that to help support the economy. But remember, we're talking about a country in which where the population shrank last year by 800,000 people. So the thing that Japan has done more successfully than the U.S. is getting a larger share of your population, and especially women, to enter the workforce. So population shrinking, but the workforce, the percentage of people working, has actually increased. Japan has a higher percentage of women working than the U.S. does, which is quite ironic. The other place that Japan has made some real changes is in terms of the military. I think that when Russia invaded Ukraine, the Japanese saw parallels with Taiwan. And the Chinese have been challenging not only Taiwan, but Philippines and Japanese unresolved, say, territorial disputes over islands. And so Japan has changed the constitution to basically be able to sell weapons, export weapons, and to take a bigger stand in defending allies. And so I think militarization of Japan and this economic challenge they have with the shrinking population are ways that Japan is really changing sort of its modus operandi. In the short run, this 152 is a key level for dollar yen. We haven't really been able to go much below 151 as we sort of trade in a very tight sideways pattern. An interesting thing, I think, is that the Japanese stock market has been on a tear, and so a weak yen tends to be good for Japanese stocks. And with the interest rate hike, that means that the interest rate margin for Japanese banks may also widen, and it's also attracted foreign investors into Japanese equities. But Japan is I want to say Europe's challenge is a bit different. They've been hit with an energy shock since the Ukraine invasion, and they still seem to be struggling. Some of the PMI numbers say that the contraction has slowed down. And what's interesting, I find, in the Eurozone these days is that the periphery, countries like Spain and Italy, are doing better than the core, France and Germany. And so I think Europe still has some problems ahead of it. It might not really begin showing any real growth until later this year. The ECB meets next week. No one's expecting them to do anything, but Lagarde, the ECB president, could still help confirm and boost the market's confidence that the ECB will cut rates in June. So when you think about this interest rate cycle, the U.S., because of the economic data, Fed cues, that maybe the Fed cuts come in the second half of this year, while the ECB is signaling a June cut.
Marc, let's talk about the U.S. bond market then, because out of anything, that's what has been selling off. And we all know how big the bond market is. Maybe that's where all this excess capital is coming from that's pushing all sorts of different sectors higher. But you look at something like the 10-year, it's closing in on 4.4%. The 2-year also much higher. Their uptrends are undeniable right now. So how much higher could rates go, market rates that is, in the U.S. in your eyes in the near term?
Yeah, I think that's what we need to focus on is with the relatively strong U.S. jobs report. We've got the U.S. 10-year yield up about 5 basis points today. The 2-year up about 6 basis points, almost 7. I mean, it seems crazy to think along these terms. Maybe the 2-year is headed toward 5%. And that would be, earlier this week we had one of the Fed presidents, Kashkari, talk about the possibility that maybe if inflation stays sticky, the Fed doesn't cut at all this year. And if you think about Fed funds rate 5.25 to 5.5, and at 5%, even right now, at 4.70 2-year seems rich if you thought the Fed was going to be cutting interest rates. But we have supply, and we still have what looks like sticky inflation. And we've talked about this in past shows, but the debate had previously been soft landing or recession, and I think now the debate has shifted towards reacceleration versus a soft landing. And so the whole like framework of the discussion and debates seem to be shifting towards sort of like, when I say extending this U.S. exceptionalism a bit longer.
So do these higher rates end up impacting either the markets, the economy, any certain sectors within the markets? There has to be, again, some correlation, although you just threw the whole correlation thing under the bus there a little bit ago, but higher rates do need to impact something, don't they?
Yes, and so what are they impacting? One, I think, impacts the dollar. Secondly, I'd say that the impact might be, instead of the classic image, I think it was Milton Friedman, talked about some guys in the shower, and you're trying to get the water on a hotter temperature, and you turn the knob, and you don't get hot water right away. And so as the hot water is heating, you keep putting it hotter and hotter, and then when it does kick in, it really kicks in a big way. And I think that's the danger, is that because policy takes place with lags, that interest rates are working. They just work with a lag time. So, of course, the higher price of money impacts credit extension. And I think that's why I still won't give up. Maybe it sounds kind of silly to say this, but I won't give up on the idea that higher interest rates are going to slow the economy, but maybe not immediately. Maybe the opening up of some supply chains, maybe the strength of the productivity gains in the U.S., maybe the higher, in real terms, that is the inflation-adjusted terms, real wages are rising. And so maybe these factors are offsetting or blunting the impact of higher interest rates.
Yeah, very well could be. I find it so interesting, right? We can all focus so much on interest rates, but we do need to remember what happened during the pandemic and the move away from globalization, which I think has definitely pushed inflation higher and was a huge constraint on a lot of businesses, but that has, it seems like, started to open up again. So, Marc, big picture, what do we need to look out for? More for investors. What could impact markets? What could change this overall bullish outlook for everything? And do you see anything right now still taking the lead, outperforming the broad averages?
Well, one thing I see happening is that when the Federal Reserve meets next at the end of April, the meeting concludes on May 1st. And if the data we get between now and then, and really it's going to be the CPI is the key one, CPI, PPI, personal income, personal consumption, that kind of thing, that imagine that at the March meeting, there were 10 Fed, out of 19, 10 Fed officials thought it'd be still appropriate to cut rates 3 times or more. 9 thought 2 times or less. So it's a very close balance. All it takes is one person to change their mind. And we won't get that confirmed until the meeting in June. But Powell could say something to indicate that there's been an adjustment. One way he could say that is really repeat what he said before, and that is in between the meetings in which they give us the summary of economic projections, these quarterly meetings, that they can get old, that you have a snapshot in March, and that snapshot still might not be valid anymore when we get to end of April, early May, let alone June. And so I think the first thing is that the Fed call was very close in March, and that could shift. Secondly, an external shock like we saw earlier this week between Israel indicating that it might confront more directly Iran, who is thought to be behind some of its the proxies, whether it's the hitting of the Red Sea or the Hezbollah or Hamas. And so if we see the war broaden out, like that's the fear yesterday, maybe that's one of the things helping gold, helping oil. And that could also be a game changer in a world, a bigger, more direct conflict. But I think that there's very little sign, it seems to me, that Europe is going to strengthen like markedly anytime soon. Same thing for Japan. And I think we've had a lot of what happened last year in China. They pump it up in the first quarter, and that becomes the peak for the year. And so I think it's a precarious time. We're sort of on the edge, and I think we just have to make it through these next few weeks, get the data, and see what the Fed says later this month.
All right, Marc, thank you, as always, for your time. We're going to wrap up the weekend show here. Pleasure having you on, Marc, and I hope all of you listening found these conversations interesting, where we were talking to a couple more generalists, more about what's happening in the commodities space, why the commodities are running, what this environment is for markets where seems like rotation of money pushing everything higher at their own times, and commodities have had their day right now for the last really month and about a week. Everyone, be sure to check out our website, kereport.com, and our podcast and YouTube channel, The KE Report, to keep up to date on all our daily editorials and company updates. As always, keep in touch with us and be sure to let us know what you think of the guests we have on and the companies we are featuring. Marc, thank you again for your time. Everyone, thanks for tuning in. I hope you all have a great rest of your weekend.
Thanks. Good luck.